Hello, class. Thank you very much for your time. This week we're going to be talking about Chapter 5. Chapter 5 can seem a little overwhelming, but I want to remind you, many of the topics that this chapter covers is something that we've already talked about or you've been exposed to in previous courses. So just try to take the time to remember what you've learned in the past because we're going to be building on that. And it's not difficult, but it's something that you have to think. I need to remember my basic algebra class and a little bit about my statistics to help you with this particular chapter. And I think if I think about it, it is a very intuitive chapter, but it does require you to kind of put together some pieces of other learning that you've had. I will create some other videos, some supplemental videos to help you with creating scatter plots and also help you with creating regressions within Excel. So don't worry, but understand what a regression is and what information you can extract from that. And that's really the most important. The how-tos of it will come later in another video. For now, Chapter 5, we're talking about cost estimation. We're going to understand why we estimate costs and variable costs and how to split them out, really. We're going to also talk about how to estimate costs using estimates, using account analysis, and most of all, using statistical and regression. We're going to identify some potential problems with regression data, really understand what it is and some of the limitations for the most part, when it's useful and when it's not, and when to compare it with other types of tools when you're analyzing, estimating variable and fixed costs. The advantages of the alternative cost estimating methods, and also with the Appendix A and B, I'm going to supplement that with a video. So I'm not going to talk about regression analysis or mathematical relationship. I'm not going to talk about that in this particular video. I will talk about learning outcomes 1 through 8, however. Why do we estimate costs? We want to make a decision. We want to be able to determine what to do next. And when you're talking about manufacturing a product or producing a product for a client, it's very important to know how much it's going to cost you. And sometimes you don't just know how much it's going to cost until you actually spent it. So why is estimation possible is why is it important? Is because you want to be able to know whether your costing is going to be too high. And it also gives you a guidebook on how to better price your products. You want to know, if you can, how much it's going to cost. And although the numbers may be a good guess, it's definitely reasonable to go through this process because you're not going blindly into creating a product that you know that you can't possibly sell. Why? Because it's too expensive. Why do different products get sold and do well for a little while and then go away? Well, management accountants like myself and you will have to evaluate whether or not the cost to manufacture and to create this product is at a level where you can actually recover and realize a profit. So you don't really know what your profit is until you can actually have an idea of what your cost is. And it's not a good idea to know what your cost is after the fact. So estimates are important in that regard. It adds value. It's very important for managers to decide whether or not this product is worthy of being created. There are lots of products out there and lots of products that could be out there. And because of cost estimations, they're like, no, we're not going to do this right now. It's not cost effective for us. We are putting way too much cost and we can't pass these costs over to the customer because it would be too high. Again, making decisions. Should we manufacture it? If we should, what's the cost data telling us? So we want to understand why we estimate fixed and variable costs. As you know, fixed costs don't change. It does not change in proportion to activity. It's pretty flat. But per unit fixed cost does change. But in total, when we're talking about fixed costs, we're talking about costs that really doesn't change. And they are there regardless of whether you make the product or not. Variable costs are going to be costs that relate to the production process, and it does vary proportionately. The more you produce, the more it's going to cost, and it goes up in that proportion. So it's very important. So when you have costs mixed together, it's important using some kind of estimating methods to separate the two, because one cost you can control and the other cost you can't. So how do we analyze? How do we estimate cost behavior? We can do an account analysis. We can do an engineering estimates. We can do statistical methods, account analysis methods. Now, again, We want to take an idea of what we need if we're going to use an engineering estimate of how we can measure cost. We need to know what the labor activity, the rent, and insurance. These are types of costs we need to be able to create some time element to it. Can we create a time element to it in terms of our rent, in terms of our labor and insurance? So how much time will it cost us? Now, when we think about the different types of methods by which we will cost our fixed and variable costs, we also need to consider what is in it for us. What added value does it give us? An advantage? What disadvantage? And this is all about having knowledge and using that knowledge to make some really, really very, very strategic decisions. Saving money is important, but you need to know how much is reasonable for you to save. How much money can you save given this particular operation? So you have to identify what's the advantage of this process. What steps that we need to know in order to get this done? How can we compare? And when you talk about the total cost of activity, we want to know what can be estimated without prior activity data. What can we do? I mean, do we have enough information? And what information can we go without and still be able to rely on the estimate? It's kind of expensive, and really it's kind of wishful thinking, I think. In my opinion, it's going to be wishful thinking. You want a little bit more grounded and more realistic basis. So account analysis, again, looking at the accounts, looking at various accounts and ascertaining how they are being used and what kind of activity is involved in these types of accounts. Identifying their costs, whether they are fixed or whether they're variable, is going to be essential, but also even looking at the fixed costs line by line, what costs don't change. Rent is one of the costs that doesn't change. You have a rent for a whole year or 3 years and the rent amount stays the same, and you pay that rent regardless of whether or not you're doing operating activities. Variable costs would be, I would say, costs associated with the assembly workers. They're not going to be paid unless they're actually doing work and they're actually producing something. So those costs and the hours that are related to that, to the salaries or the hourly rates to those individuals on the assembly line, is going to vary depending on how much work that they're going to be doing. So looking at the accounts that are variable, that change based on the activity, and analyzing those types of costs and those types of activities, doing the same thing with the fixed amount. All the accounts that are fixed in nature, don't change, are relatively the same. You look at those activities and analyzing exactly what's happening with your costs, and you can get a good idea of what's going on based on that analysis. So again, if you're going to use the account analysis approach, again, you're taking these costs and you're isolating it. You're saying what costs are going to be to fix his $13,000 of costs for our office rent. But you doing your analysis is going to say, okay, based on my detailed analysis of my account, I can tell you 7,000 of that is going to be fixed. It's not going to change at all. And looking at your accounts in detail analysis can really give you an idea of what's going on. So I would put a lot of weight in the account analysis method if you really don't want to go into the area of statistics. But statistics does give you offer some advantages as well. So again, using this now analysis, we can get some idea of how to cost our fixed and our variable costs. How can we estimate? How can we create some estimate of what our costs would be? And again, it's all about estimates. This is not 100%. So you really have to know what your organization, how your organization functions and how useful this information will be to you and how closely does your estimates align to reality. So again, knowing the advantages and disadvantages and weighing those, determining what's best for the organization. Statistics is going to be more mathematical, and it's important to know that math is not a bad thing. Math is a good thing. We need to understand what math gives us, and we need to understand the appropriate steps to take in order to create an estimate. And we need to make certain that the numbers that we're given make sense. Very, very important. Does the numbers that I'm creating, the estimates that I'm creating, does it make sense? So when we're using statistics, we are going to be analyzing costs within our specific range of activity. We want to be able to determine our lower and upper bounds. What is going to be the parameters with which we're going to stay within? Okay, that's going to be our relevant range. How we're going to state our upper and our lower and what's in between. We're going to be using statistical information in order to analyze what the numbers are. And again, we're using statistics. You're going to see some ratios. You're going to see some formulas and some equations. So don't be alarmed by this. These equations are very, very basic, and we're going to be using them in this chapter. Using Excel, I definitely would not suggest you use this prepare this on paper, but using the data in the previous screen, we can plot and create a scatter graph. And a scatter graph in this case shows relationships. If you can look at these numbers here, you'll see that they're very closely aligned together. And then once we do that, we need to look at the scatter graph and determine if there is a relationship among the costs. Let me go back to the previous screen. If you can look here, you'll see that we have a month in one column, overhead costs, labor costs, direct costs. And what we want to do is be able to use a statistical format of scatter plot and see if there's a relationship among the data. If there's a relationship among the data, we can now safely and accurately and rely on the information in the scatter graph. The scatter graph truly want to tell you whether or not there's a relationship between hours and overhead costs. And my question to you before we go to the next screen, can you tell from looking at the screen if there's a relationship? Are these two variables related to one another? Now, with this particular line going straight through, that line going straight through pretty much helps you visualize, eyeball, if you will, how closely these little dots align to each other. And if you can see how closely these little dots are I guess, towards these, the line, how closely does these different plots or different points line up to that straight line? And the closer they are to the straight line, the stronger the relationship. You can see a few outliers here, which are on the upper part, and then you'll see a few outliers on the bottom. But for the most part, there seems to be a very solid relationship. So this line here, what does this line represent? The straight line that goes straight through here. What is that called? That is going to be the intercept. That's going to be your slope of that line. It's going to really be important. And we're going to show you how to calculate that. So how do we create an estimate of our cost using statistics? We also use a scatter plot. And again, the scatter plot told us eyeballing it, whether or not these particular transactions or these different variables are related to one another. And if they are related, how strong is that relationship? Using that straight line provides us with that a little eyeball guide to say, yeah, there is a relationship and it's relatively strong. There are a few points, however, that are outliers that will have to be drilled down and researched. Another method is the high-low method. High-low method is going to be using activity levels at the highest point and the lowest point. And what you're doing here is you're trying to create the slope. You're going to be creating the slope. So looking at that, now we want to know what is our variable cost per unit, the highest level of activity minus the lowest level of activity. And we're going to and then we're going to take and look at our highest level of activity, subtracting from our lowest level of activity. Again, the variable cost per unit, high-low method. And again, what we want to do using this method is determine what is our slope. And it's a very, very useful estimation, and it's not very difficult to do. So again, fixed costs. Now, again, we're trying to find the net change. In the high-low method, I think very much looks like the slope, the intercept of the slope, and how you calculate that. You want to calculate the change in this and the change in that and divide them into each other to come up with that number. And this is basically the same thing. And again, if we could see here, the variable cost, we're seeing the change here. In this case, 55 and 35, and then we do the change here and labor overhead, and we're dividing them through to come up with our labor head per unit. This is using the high-low of estimating. So now that we have our $27.13, we can now calculate or estimate how much it's going to cost us per labor hour using our figure. And again, not a major difficult computation. We're just giving you a different way to analyze variable costs. And then when we take our variable costs and add to that our fixed costs, we can come up with a good estimation of what our total cost will be. So how do we do that? here is a calculation that I think we're going to be using. TC is going to be our total cost. Our total cost is the equivalent of our fixed cost plus our variable cost. When we use the high-low method, we are going to be calculating the V in this calculation. The X is already given to us because we see in here 960 hours is our X. So in that calculation that you've seen in the previous screen here, calculating the difference or the change in our high and low numbers versus our variable costs, we come up with our 2713. Again, think about it like this. We're calculating the change. And here's the numbers, the 55,000 minus the 35, calculating the change in the labor hours, the 1136 minus the 400, to divide them together to come up with our variable, our $27.13 per labor hour. That's our variable cost. So, and essentially what we had done is calculated the V. Because if we're already given the X and we know what the fixed cost is, we can now calculate our total costs. And that's how we do it. So this is not a really complicated particular example, but I would suggest highly understanding what the high-low method gives you. And all it gives you is the V in this equation. You most likely will be given the X, and you can, given enough information by an example, calculate the F if it's not given to you. So again, we're trying to emphasize various methods of determining how to calculate costs. And I'm talking total cost. And total cost is a combination of fixed costs and variable costs. So the regression is a statistical procedure, and it's going to show a relationship. How are these two related? It's like having a brother and a sister. We are related because we're siblings, or we're related because we're parent to child, or related because we're parent to child to aunt, or child to cousin. That's relationship. The relationship is called cousin. The relationship is called brother or sister. The relationship is called mother or father. In this case, relationship in this case is going to show how strong these items or these variables are related to each other. How are they related? Is there a strong direct relationship to each other, or is there an inverse relationship, or is there no relationship whatsoever? They are scattered. They are not impacted by either one of it. If something happens on this side, it doesn't necessarily mean it's going to affect the cost on that side. So what we're trying to do is determine if there's a relationship and how strong it is. So we already talked about using the high-low method. Now, regression method uses all data points. Remember, when the high-low method, we took the highest and the lowest of both variables, and we calculated the change and divided them through together. So we took 2 data points basically, and there's nothing wrong with that. But when you're talking about lots and lots of data and you talk about more complicated processes, a regression may very well give you a more realistic and a more accurate estimate because it uses all data points. So, and the regression here is y is equal to a plus bx, meaning the slope is going to be the b plus x is the variable. So we want to be able to use that. So using the regression analysis and using it within Excel makes it so much easier because it does all the calculations for you. Your job is to know what the information is telling you, how to find out what's the slope, what is the how can we determine based on the regression analysis output whether or not the relationship is a strong one? What's our factor? So that's more analyzing the information versus computing it and calculating it. So what you want to do is you want to determine what the independent variable. Again, as I mentioned before, a regression analysis done in Excel does all the calculations for you. So your job then is not so much learning how to calculate it because you let Excel do that for you, more so than understanding the results that it provides you, making sense of the numbers that you see on a screen. And we're going to talk about this very much in an example. So don't go overwhelmed with this. Just understand what a regression analysis is and how to use the data to interpret the information so that the information that you get, you use it correctly and a decision that's appropriate is made, a good decision. So we're going to be talking about the independent variables, about the dependent variables and the cost. And again, we want you to interpret the information based on a regression. And again, this is not very difficult to do. You just have to understand that there may very well be a linear, straight across relationship. So when there's a linear relationship, you're going to see the R And that's what the R is going to be telling you. It's going to be telling you the correlation. How are they correlated to one another? If they are correlated closely, you're going to be close to 1. The closer the points are to 1, that means it's closer to the regression line. That means it's going to be a correlation. That means it's going to be a very, very strong relationship. If it's below 0, it's closer to 0, that means it's not necessarily related to one another and has a poor, I would say, a less reliable relationship and less strong, very weak relationship. And now the correlation of determination. This is just basically telling you the square of the correlation. It just takes it and squares it. And what it does, it gives you the proportion of the variation. What's different between the X and the Y, and how does the dependent variable is explained by the independent variable. And it really makes more sense when we use an example, and which I'm going to do in another video. The most important thing is, how are we going to get information, and what does the information actually mean? So T-statistic, again, I won't get too deep into this right now, just to know, because I'm going to give you an example so that it can help you understand what it means. But using statistics, we're trying to calculate whether or not the value of our coefficient is significant, if it's not significant, if it is significant. And that's really the most important thing here. And the guidepost is going to be, if it's over 2, it's going to be considered significant. If it's under 2, it's going to be relatively insignificant or not totally significant. So what we want to do is, when we were preparing our regression analysis and we're looking at the data that's there, we can take each one of those points and interpret exactly what's going on. So what you need to do when you're reading through this chapter is understanding what the T-statistic is, understanding what the correlation or coefficient is, and how to find it on a regression analysis. And when you're reading it, what does these numbers actually mean? What's the guidelines that you can look at, the guideposts that you can look at to make some decisions? If it's a relationship, is it strong? Is it a weak relationship? Does this information provide me with a significant relationship, a significant correlation? If it's not significant, what do I do? Why am I not concerned about if it's not significant? That would tell me that this particular analysis between the variable costs and fixed costs are not relating to one another. They're not actually moving together, and they are not going to be a reliable basis upon which to say, if I change this in my variable, it's going to impact my overall total cost calculation or my total cost estimates. So the regression analysis is not necessarily a hard thing. It's just that there are some tools that you'll need to use in order to understand exactly what these regressions are telling you, so that you can make a decision. Someone asks you a question, well, why would you maintain your level of production given the regression analysis? You can say because, and you can take that regression analysis output and explain why. Now, multiple regressions, I'm not going to touch either, because I really want to show you in examples of that. I would say first, understand what a regression is and what it does and how you can use it, and understand those particular output values and how they relate to the analysis of costs and variable costs. Also understand how high-low method works and its limitations, and also the limitations of using a regression analysis, and also understand the relationship of a scatter plot. Again, we're using statistical means by which to analyze costs, and which method works and why they work well, and what the advantages and disadvantages of each. And in some cases, how can we calculate costs or estimate costs based on whether we use the eyeball method, account analysis method, a statistical method, whether it be high-low method, scatter plot, or regression analysis. So, downside to regression. Again, nonlinear relations are going to mess things up. It's going to really make things look hard to interpret. Outliers, as I identified a couple outliers within the high-low and the scatter plot, there are some costs and some relationships that are just going to go off and have no relationship whatsoever and can't really be reliably predicted. There are going to be some other relationship that don't fit the assumptions and don't make any sense. So when you're looking at regression analysis, you got to think about that. Does it make sense? Does this information make sense? Can you explain what's happening and what you see on that screen when you've done your regression analysis? Very important questions. And sometimes it's because these particular variables don't work together. They don't mesh. And you can't use them together to form any kind of conclusions about estimating costs. And that's essentially what we're trying to do here. And here just gives you a visual of the effect of nonlinear relationship. A linear relationship is going to be straight across. It'll be straight up and down or straight right across. A straight line. And you can see here what the effect it would look like when you're trying to evaluate nonlinear relationships. So how do you attempt to fit a linear model into a nonlinear model? Again, you're just going to have to find more than one way to analyze the information. Using regression on its own may not give you enough information to make a decision. And that's all it's saying. It's all it's saying. Can you make a decision based on regression alone? And sometimes you cannot. You cannot do it. And so again, outliers move things. It makes things look a little bit strange. Maybe a scatter plot would probably help you better understand the relationship and what's happening with the numbers. Again, don't be stuck in regression analysis when you see that there's nothing making any sense, that when you interpret it, it's not giving you any true answers. Maybe you're dealing with outliers. Maybe you're dealing with relationships that are not very strong. Maybe you're dealing with other types of situations that are really making it difficult to analyze numbers, which is why regression analysis may not necessarily be the end-all, catch-all of cost estimation. So, and again, go through your chapter. Think about some different ways to analyze your costs, that assumptions that may not necessarily fit in the regression. They may not answer questions within the regression. It's a complicated model. It can be used and it is useful, but sometimes it isn't. And knowing when it's not useful is most important. So when we are trying to determine the level of relationship and the strength of relationship and mean costs, it is important to note that we have to think about what we're doing. We got to think about why we're doing it. And we got to think about the output it is giving us. It really has to think about this. It really has to make sense. I mean, you're talking about real data and you're trying to make a decision about data, and nothing that your output doesn't make any sense. It seems random. It seems scattered. One would suspect that maybe the relationship that you think is strong may be weak. Maybe there are some outliers within that data that's skewing the outcome. But think about that. So whatever you decide to use in your cost estimation method, make certain that it's reliable, that the data that you can retrieve, it makes sense, that you are that you're interpreting the output accurately. Make certain that you understand what that particular method gives you, the advantages of it and the disadvantages. Be aware of that. When you can't interpret the data, if it doesn't make any sense, think about whether or not there's missing data. Maybe it's an outlier. Maybe there's something inflationary cost. Maybe there's missed period. Your time frame is off. But think about those types of things when you're trying to analyze your cost data, and if it doesn't make sense. And again, going back to the reasonableness test, which is going to be essential in accounting. Is it reasonable to suspect that this particular method of cost estimation is working for us? Is it reasonable? Can we explain based on the output that we're given? And the answer could very well be no. We need to go back and think about another method by which to analyze the data so that we can make a reasonably responsible decision. I'm going to stop at this point because I want to be able to show you in demonstration model how to create a regression analysis and how to interpret it. I thank you very much for your time, and I'm hopeful that this chapter didn't discourage you. And any questions that you have, please don't hesitate to ask.